How you guys doing? I just wanted to do another video. I just wanted to touch further on, I got a lot of people asking how you know which strike price to pick in expiration. So I wanted to go a little further in and explain, how you pick expiration and your strike price mainly. So as you all know, if you've watched the first video I put out, options, they're a great way to be able to play these more expensive stocks. Instead of paying $200 a share, you can buy the contract. Now it's a little more difficult because you have to pick a strike price, and they have expiration dates. Well, here's an option chain. So with knowing how to pick the expiration, it's really not that difficult as people make it out to be. Here's your different expirations. You have weeklies and then you have monthlies. The weeklies, you have them that sometimes they'll expire on a Friday, and then you have your monthlies. But let's take Tesla for example. So today Tesla made a huge $7 run. Now if you were going to play options here and you were just going to day trade them, you were going to play, you could have played the December 16th expiration, which today is the 13th, so they expired this Friday. You could have done that. Now with this move, ideally you want to try to pick somewhere, the further out of the money the further out of the money, the cheaper they're going to be. So you have at the money, which is where the stock's at, and then if you're playing calls, the further out of the money is going to be, the higher the strike price. It goes from 197.50. Well, this is at the end of the day, but at the money would have been around 193 when the market opened. But so the more you go up in price, the further out of the money it's gonna be, and then the cheaper the contract gets. You have to remember, guys, they can't, there has to be a reason to entice people to want to play further out of the money, because, otherwise, if they were all the same price, what would make somebody want to buy something further out of the money, and take a little more risk? Well, the reason is because you can get a better return because they're cheaper, and, you can get a way better return on your money also. The way they move and stuff, they're more risky, with more reward can come more risk. So they are more risky, but you can make a lot more. So let's just say that you didn't know that it was going to make this move, but let's say you had an idea that it was going to run, Well, it went to 201. Now you could have played the 201 strikes and still made money, but you could also play it a little further in, because ideally, whatever strike price you pick, you want it to not only get to your strike price. So right here, you would have played like the 197.50s, because you want it to not only get to your strike price but go through it. Now you can, if it gets to your strike price, you're still fine. You would have made money if you'd have picked the 201s, or you could even play it at the money or in the money, and you would have been fine. But best case scenario, ideally, now this is obviously, more of a risky way, because, you could have played at the money and not been as risky. But if you wanted to, what would be the ideal play? You wanted to pick something around here. That way it not only got to your strike price, but it went through it, because there's a thing called delta, which tracks how much your option contract moves compared to how every time the stock moves $1. And once something goes in the money, your delta changes. Your delta will go up, and option will start paying more, when something goes into the money. So once it gets into money, remember that, guys, it's going to start paying out. So ideally, with options, you want to pick the closest strike. You want to pick as far out of the money as you can, to get it for the cheapest possible, but also close enough to where it can not only get to your strike price but go through it. Now it's okay if it doesn't, you're never going to be able to You remember, this is kind of like buying dips or shorting pops. You're never going to buy the bottom, and you're never going to be able to sell at the top. I mean, you might get lucky, but the same thing here. You're never going to, be perfect every time and pick right in between, but that's ideally what you would want to try to do. You might would have wanted to play, even like the 194s would have been good strike prices today, all the way up to the 199s would have been good. Anything in here would have been an awesome play. And you have to also worry about expiration. Now, I day trade, so typically I'm playing the weeklies, and you just with playing weeklies, you probably should be day trading them. Now you can hold them overnight, or you could hold them for a couple days if you want, but options have a thing called time decay, and every day that goes by, price is gonna get chipped off of your option contract because of time decay, and the closer it gets to expiration, the more that time decay is going to hurt you. So if you want to hold longer than a day or two or whatever, you can, but you would need to make sure if you get some consolidation, like for instance, if you would have bought here, right here on this day, and you bought the December 16th expiration, well, if you held it for this 4 days, now notice, you would have bought it here, right here. Let's say you bought an option contract, you bought it there, and then you come here. Stock really didn't do much, so you would say, okay, well, I might have broke even. Well, if you bought the stock, you would have broke even, but if you would have bought it here, option contract, and you would have held all the way to here, you would have lost money because the stock just consolidated the whole time and you didn't get a move, and therefore, since you didn't get a move, time decay is going to kill you. It's not like you can just buy a stock and then sit on it forever. Remember, guys, it's all about timing, and it's all about picking the right strike price. So expiration is one of the most crucial things. So normally, if you're going to hold for a few days, you want to buy a little while out. You want to get something that's get a weekly that's maybe 2 weeks to expiration, or get something that has a 1 month expiration to give yourself more time. Now remember, the more time you buy, the more expensive they're going to be. They're going to be more expensive when you get more time. Remember, they have to make these cheaper, the weeklies and stuff like that, because they're a little more risky. So just look at it as like, the further out in time you go, you're giving yourself more time, but you're going to have to pay for that time. You're getting more time for that stock to make that move. So what happens if you were to buy that you bought a monthly though, and it didn't make, let's say you bought something with a month expiration and it didn't make that move? Well, you still got plenty of time for it to make that move. Now you could have held it all the way to here, and then look, you got the move you wanted, you made your money, and then you could sell it back into the market. But they're not going to give you that time for free. Now, there's a lot of misconceptions with options that you have to wait to expiration and all that. Well, look, guys, you don't have to wait to expiration. That's not how I play options. Now, you can use options as an insurance policy. For instance, if you own shares of that stock, you can buy puts, maybe to protect yourself from downside, and I do that from time to time. But typically the way I play them is I'm playing them just as a, because you can also do spreads and stuff, and I'll get to that in later videos, different strategies you can do. But there are ways that you can play spreads where you can sell options to where if you were this consolidation right here, that there are strategies with options to where you can actually profit from when the stock is doing nothing. You're in this big consolidation for a few days, stock isn't doing much, but there's ways with options that you can make money. Now, typically I play it as just a strictly day trading as a directional thing. That's all I'm looking for is getting a directional play out of it. Therefore, I'm buying calls and buying puts. But you buy the option and then you sell it back into the market. Remember, the contract of the option is controlled by, you have delta and things like that, but it's also controlled by the perception of what people are willing to pay for that stock to make the move to whatever strike price you're paying. You're playing. So for instance, if you were to buy the 194 strike when the stock is at 193, I mean, if you were to buy, let's say you bought the 197 strike, or the 195 strike price when the option was here at 193. Well, once the stock gets to 195, or let's say once the stock starts going, for instance, if you bought it here, let's say it was worth $1 here, but then it got up, so the stock gets up to, you played the 196. Let's say you played the 196, and the stock gets up to 194, 195. Well, the closer it gets to 196, the more people are gonna be willing to say, "Hey, I think it's gonna hit." I think it's gonna hit 196. For instance, if someone said, "Hey, how much?" The stock was right here at the open, and they say, "Hey, I'll bet you $10 that the stock doesn't get to $200." Okay, well, you might say, "Well, I don't know, it's way down here at 193, and then it starts creeping up, and you're like, yeah, it looks like the stock is going to go on a run, it's going up," and maybe you're looking at your indicators, and you're like, "But I don't know, $10, you want to bet me $10 that it's going to go to 200, I'm not so sure yet." But then the stock starts going up, and it gets closer, and then it gets up here to 197, and you're like, "You know what, I won't bet you $10, but I'll bet you maybe $7, or $5. But then the stock starts getting even closer to 198 maybe. Now you're like, "You know what, I will bet you that $10. Why? Because it's closer to $200, and it's not as unlikely that it's going to make it than whenever it was way down here. Therefore, you're willing to pay more for that bet." Well, same with options. People are going to be willing to pay more the closer that strike price gets to the stock, because it's more of a more likely that you will see it touch that. Now, if you were to buy the 200 strike prices way down here, they would have been very, very cheap. And then once it got up here to say 199, you could have sold them for a big profit, because people were going to be willing to pay more for that, thinking that it was speculating on it to make it to that $200. And you can sell it right back into the market. You don't have to wait for expiration like these people think, and like they teach you in finance classes and all that. You don't have to do that. That's a big misconception. But you just have to worry about getting the expiration and your strike price right. So when you're swinging options, now you got some people who are playing really small size, but for people who are playing larger size and you want to swing for, let's say you want to take I know there's these people out here who, want to swing for a month or two. Well, it'd probably be, and you're playing a little, kind of, a little, not too big, but you probably I wouldn't buy everything at once, because option contracts are really going to fluctuate a lot. You can buy on dips, I mean, obviously, if the stock shot straight up, then you might, could have bought them all then. But most of the time, you're always going to be able to get them for cheaper. You're going to buy a little here. Like, let's say you're buying in here, for this run. Well, you want to kind of, buy on dips. Maybe not buy everything all at once, because they'll always get a point to where you'll probably be able to get them cheaper. So you might want to build a position. But normally, I strictly day trade. But as far as swing trading, you want to make sure you give yourself enough time. If you're thinking it's going to take a month to make that move, you probably want to buy like a 2 months out, at least. I would buy like a 2 months out or something. Now, if you're going to be planning on holding, for just a week or two, you could buy a monthly. I would probably buy a monthly expiration. The only time if you're buying a weekly that expires that week, you probably just want to be day trading it. And I mean, if it goes on a real good run, you can hold it for a couple days, but you're going to have to really make sure you get that move in order for it to really make a difference, So just remember that. And another thing that's good about options is you can't lose more than what you put in. So for instance, say you have say you got like a $10,000 account or whatever it is, $5,000 account, and you want to invest $1,000 into a stock, but you don't have all day to look at it. Well, you could invest that $1,000, and we all know that if you're not paying attention to it and it starts to tank, or you short it or whatever it is, and it starts to run, you can look back and even though you only, I mean, yeah, you have you have stop losses and all that, but even if you didn't want to only lose $1,000, you could still lose more than that. You can lose more than you put in. Options, you can only lose the amount. You can only lose, like, whatever you have a fixed loss. Like, so for instance, if you were to buy, let's say you bought 10 contracts of a 195 strike or whatever, and you bought them at $1 a piece. Well, only thing you paid for them was $1, and let's just say you invested $1,000 or whatever, and you got 10 contracts or whatever it is, however many you bought. Well, if those options, all they can do is go to zero, and once they go to zero, you lose your investment. So you're only going to lose your max loss is always going to be, it's always going to be a fixed amount, and then there's unlimited upside when you're buying calls and buying puts. Same with puts, same thing. Whatever you put in, that's what you can lose. If the option goes to zero, and then your unlimited downside, and then you don't have to worry about getting shares to short. You don't have to worry about only being able to hold them for 3 days. The 250 rule. Well, I mean, these stocks are going to be more than that anyways. So, but it's to me, it's a lot more efficient way to play. I mean, just from my experience, it's really not as complicated as people think. Really, what you need to focus on with options is just buying calls and buying puts when you're first stepping into it. And just play it as a directional thing, and if you want to get more into it, if you want to use it as insurance policy, like for instance, if you had shares of the stock, you could buy puts on it to protect yourself from the downside. And when the stock goes down, you're gonna so when you buy a call, you're long what they call delta. And I'm gonna do a video on all the Greeks. Options have these things called Greek, and that's what tracks the price of the option. So you're gonna be long delta. So when the stock goes up, your delta is going to go up also once your option goes into money, and that's what's going to make your option contract go up. So when you buy a put, you're going to be short delta. You're going to want it to go down. Now you can also sell calls and you can sell puts. Now, and then you can also do strategies to where you mix that up and you sell some calls and then you sell some puts. You can do a bunch of different strategies, guys, with options that where you can capitalize on consolidation, all those things. But for me, I really just play them as a directional move. So if I see a move like this, I would get in. Now, I like to usually play a little out the money or at the money. But like I said, figuring out the strike prices, you're probably going to want to just play at the money. But ideally, remember, you want it to not only get to your strike price, but you want it to go through it. And that's whenever something's going to really, really pay out. And let's see. So for guys that are swing trading options, you don't want to hold too close, to expiration, because that's when time decay is going to kill you. Like, yeah, you're going to have to pay more for these contracts, but I mean, you can still make good money. Options, you're gonna make way more. Like for instance, this stock. If you would have bought this stock at 193 and then went to 201, I mean, what is that? At $7 is like, that's nothing. That's only I mean, $10 would be 20%. So let's just say it's 15%, or something like that. It's not much. You wouldn't have made that much. But if you would have bought an option right here, let's say you would have bought the 195 contract, you would have probably made, it's a possibility you could have made 100%, 200%, I mean, there's no telling. You would have for sure, I guarantee you would have probably for sure made 50% if you would have got in right here and you bought the 197 calls or whatever, and you sold it right here, most likely you would have probably made 100, 200%. I could look at, let's see. Let's say you played the I don't know if it's gonna work right now, but let's see. The 197.50s. I don't know if it's gonna be accurate right now after hours. So yeah, it is coming up. Now look, these things were going for $1.40. You could have got them for $1.40, and they hit a high of 5.10, guys. So you would have made, I mean, you do the math. 100% would have been $3. 200% would have been, so yeah, 100% would have, yeah, but let's just say you got them at 150. So 100% would have been $3. 200% would have been $4.50. So you'd have made about 250% off of these options. That's what you would have made today. Look at that move. For a fraction of the cost, guys. You could have played them for 150. So let's say you got them at 150, and I know a lot of guys don't have big accounts. So let's work this out. Let's say that you wanted to buy. Let's say you wanted to just play 10 contracts. So you got 10 contracts times 1,000. I mean times 100. Remember, everything's times 100. So remember that's 1,000. So 1,000 times 150, $1,500. So for $1,500, you could have got a piece of this, or you could have played 5 contracts. You could have played 5 contracts if you wanted for $750. Either way, though, if you were to put that $1,500 in, you could have turned that $1,500 in, to $3,000 or more. You could have turned it into $4,500. Depending on how long you would have held it. And so, and the thing is you see these big moves in these bigger stocks like this all the time. Like, look at this, and it's a good way to be able to play these bigger stocks that are making these big stocks are making these big moves like this every day, guys. Like Google. Let's see if something else, what else made a big move today that I can show y'all. Now look at Amazon. Amazon made a huge move today. If you would have bought some calls, let's see what the 775 4 calls would have came out. 774 calls, somewhere around there. All right. So it came here. Let's see. The stock started at around 763. Let's do around 775, 776. Let's do the 775 calls. So I can come here, more info. I think it's from chart. Now these options went from 250. Look at this, guys. 260 to a high of $12, guys. That's more than 400%, guys. That's like, okay, so 5, 10. It's like it's like 500%, guys. So I mean something like that. So look at that, from a low of 243, let's just say 250, up to a high of $12. So you could have invested. You could have easily played these. You could have easily played 5 contracts. Let's do the math for you. You could have easily played 5 contracts. So remember, 5 contracts. What do you want to do? Multiply that times 100, right? All right. So 500 times 250, because you're going to pay $250 a contract. So you could have put $12.50 in this, and you could have made 4 times your money. You could have made $5,000 off of this today. And if you were to play the stock, what would you have made? 10%, 5% maybe? I mean, what? The stock's up, let's see, trade. What, the stock made a 2% move today when you could have made 500%, 400 or 500%. This is why I play option, guys. Now you see, I'm glad I did that. Now you see how much you can make. And so I want to go back, and I'm going to see what we're going to see. Let's see if you would have played at the money. let's see how much at 763 all products 7. Let's say you're gonna play 762.50s. Now you would have made about 150%. You know, it went from around $7. You'd have made about 200%. See, they didn't pay out as good. You get what I'm saying? So now you can see that when you would have bought the 197s up here, it paid out a lot more because, you know, not only did it get to that strike price, it went through it. Sorry, the 775s. It went through it. So now you can see how more of the payout's going to be. So remember that it's all about, you know, you don't need to worry about trying to, you know, it's kind of bad for me to say this, you know, because I don't want people to go out there and be trying to guess exactly where a stock's going to go and be really caught up on trying to get the perfect strike. But it is important to know, you know, what strike's going to pay out the best. But I just don't want y'all guys to be, you know, it's best just, you know, try to be a little conservative, play at the money or play a little out the money you can. But, you know, now just so you know, best case scenario is always going to be when you pick something, you know, maybe a little more, like 3/4 of the way. You know, this will probably around here be your best case scenario because it not only did that, but it went through your money, into the money. So guys, now you see how much more options pay out. You know, I mean, it's just the returns are ridiculous when it comes to options. But I just wanted to do a quick video about how to pick your strike and a little bit about picking strikes and picking expirations. You know, the quicker it gets, the more it gets closer to your expiration. Remember, the more time decay is going to kill you. So just make sure you buy enough time if you're swinging these things, and if you're day trading, don't hold them more than a day unless you really plan on them to get a big move. And then you have more factors if you're interested in learning more about the Greeks and you're interested in learning more about different option strategies, like how you can capitalize on markets that are consolidating or how you can do spreads. I'm going to do another video come next week about that. But I'm going to go ahead and wrap this video up. This is just a quick video about how to pick your strike prices and to show you kind of the way options work and how much you can make off of options. So y'all stay tuned for more videos, and I'll explain some more cool strategies y'all can do in the future. Y'all make sure y'all subscribe and like the video. Thank y'all for watching.